I think this is a key factor why the lira has weakened so much. And if you remember, the trigger for the lira falling so much last week was when the Americans first announced sanctions on the Turkish ministers. So definitely having an easing of relationships between the US and Turkey is one of the key kind of prerequisites, I'd say, for the lira to find its stability. Now, I agree with the report that the latest trade tariffs, I guess, were a bit more of a symbolic move. The trade between Turkey and the US is not that much. 15 million in tobacco goods is not really something that's going to hurt either real economy. But again, the symbolism behind it, the idea that it's looking less and less likely that the two countries will find some rapprochement is definitely going to be something markets are worried about. If you remember, there was a supposed deadline to release the pastor by yesterday PM. That hasn't happened, so we have to wait and see what the next moves are going to be.
And certainly we would expect to see some relief if in fact we get an agreement to release the pastor, but really it is the economic situation in Turkey that has rattled markets for quite some time. I mean, in the absence of an interest rate hike, which doesn't seem likely, how do you see the economic situation improving, if at all?
Yeah, exactly. So, I mean, the political story was just the kind of icing on the cake. The real reason behind the lira weakness is, as you mentioned, the fundamental deterioration in this economy, which is really due to a few things. One of them being that the narrative behind successive election gains in Turkey have always come with a sort of sense of pragmatism from the ruling party. And this time we're seeing that pragmatism sort of evaporate. The country is facing a funding need crisis, which is going to need to find about 200 billion worth of funding for next year to cover its current account deficit and to cover its short-term debt repayments. Now, that kind of money is hard to find when your portfolio flows are flowing out, and portfolio flows financing a large chunk of that. So in that sense, I think, you know, unless the Turks come up with a way to stabilize the situation, it's going to be difficult. Now, one of the key ways to do that is to raise rates. As we know, President Erdogan is very averse to doing that. But I think, you know, the Turkish central bank is playing that same game that we've been used to it playing, which is that they'll tweak on the margins, they'll do some backdoor interest rate hikes. That's not going to be enough this time. There's going to need to be a little bit more action on that front, especially when you think that the inflation, the exchange rate pass-through to inflation is likely to be very high. So we're going to see inflation topping 20% or more in a few months, and that's going to require much higher rates than where we are now.
Enough as that debt problem you're talking about has raised concerns about European banks that have exposure to Turkish banks, although a note coming out from Eurasia Group this morning said that some of those concerns essentially may have been overblown and that, in fact, the vulnerabilities, the exposure, and the risks of financial contagion may not be that great when it comes to Europe, that is. Do you agree?
Yeah, I pretty much agree. I think that initial report that came out was a little bit overblown. Maybe the most exposed country would be Spain through BBVA, but then again, you know, the European banks own Turkish bank subsidiaries who end up loaning in lira as well. So it's not just a pure FX exposure. The banks themselves are pretty well capitalized. They've got good kind of coverage for short-term external debt, at least. That chart that you're showing up there is essentially masking the fact that in the short term, at least, they have enough FX deposits to cover the FX liabilities. That being said, you know, I think the weak spot in this whole setup is the banking system. I think right now we're still in an okay place, but you know, if we're in the same situation in 9 to 12 months, I think the banks here are the weakest link because they're exposed both from their own finance funding side, but also on the corporate liability side.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.